Will Tata Sons Escape Listing? RBI new rules explained. Complete legal analysis. Imagine waking up tomorrow morning and reading this headline: Tata Sons may never have to launch an IPO. Sounds unbelievable? For almost 3 years, everyone believed Tata Sons would eventually become a listed company. Investment bankers expected one of India's biggest IPOs. Investors were waiting. Financial analysts were discussing valuations running into lakhs of crores. Then suddenly, the Reserve Bank of India changed certain regulatory provisions. Now, one simple legal question has become the biggest corporate law debate in India. Can Tata Sons legally avoid listing? Today, we are not discussing rumors. We are not discussing media speculation. We are going to analyze the actual law, the RBI Act, the RBI regulatory framework, core investment company directions, scale-based regulation, upper layer NBFC framework, and finally, whether Tata Sons still has a legal obligation to list. By the end of this video, you will understand why this issue is much bigger than Tata Sons. It affects every large holding company in India. It also teaches us how RBI regulates financial institutions. So watch this video till the end because every part builds on the previous one. Introduction. Hello everyone. Welcome back to Corporate and Securities Law Compass. On this channel, we simplify complicated corporate laws, SEBI regulations, RBI regulations, FEMA, IBC, and corporate governance using practical examples. If you are a company secretary, chartered accountant, cost accountant, advocate, law student, compliance professional, director, or investor, this channel is specially designed for you. Now let us begin. Part 1. Understanding the controversy. Before we study the law, let us first understand the controversy. Whenever we hear the name Tata, we immediately think about Tata Consultancy Services. Tata Motors, Titan, Tata Steel, Trent, Indian Hotels, Air India, and many other successful companies. But have you ever wondered who actually controls all these companies? The answer is Tata Sons Limited. Tata Sons is not simply another company. It is the principal holding company of the Tata Group. It owns significant investments in many Tata companies. It guides strategy, it appoints directors, it protects the Tata brand. It takes major investment decisions. In simple language, if the Tata Group were a country, Tata Sons would be its headquarters. Now here comes the interesting part. Tata Sons is not a commercial bank. It does not accept savings accounts. It does not provide home loans like ordinary banks. Then why is RBI regulating Tata Sons? That is exactly where today's legal journey begins. Pause for a second. Suppose you own shares worth several lakh crore rupees. You don't manufacture products, you don't provide services, you simply own controlling investments in different companies. Should RBI regulate you? Most people would immediately answer no. But RBI's answer is sometimes yes. Why? Because financial regulation is not based only on what a company does. It is also based on the risk that company creates for the financial system. And that is why the RBI Act becomes important. Part 2. Why does RBI have the power? Many people think RBI regulates only banks. That is one of the biggest misconceptions. The Reserve Bank of India also regulates non-banking financial companies. These are commonly known as NBFCs. The legal authority comes from Chapter 3IB of the Reserve Bank of India Act 1934. The first important provision is Section 45IA. This section lays down the statutory framework for registration of eligible NBFCs. The second important provision is Section 45JA. This provision empowers RBI to issue prudential directions. Using this power, RBI issues master directions, governance norms, and supervisory frameworks. The third important provision is Section 45L. This section empowers RBI to issue directions in public interest. These three provisions together form the legal foundation of RBI supervision over NBFCs. Without these provisions, there would be no legal framework for RBI to regulate entities such as eligible core investment companies. Practical example. Imagine you incorporate a company under the Companies Act. Can you immediately start a finance business? No. If your activities fall within the RBI framework, you must also comply with the RBI Act and the applicable RBI directions. This shows an important principle. The Companies Act creates a company, but where the business is regulated, another law may also apply. That is exactly what happened in the case of Tata Sons. Now we have solved one mystery. We know why RBI has the legal authority. But another mystery still remains. Why did RBI classify Tata Sons under a special category? Why not treat it like every other company? The answer lies in one term: core investment company. And trust me, this one definition changed the entire future of Tata Sons. Today's recap. Before we end this episode, let us quickly revise what we have learned. First, the controversy is not about whether Tata Sons is a good or bad company. The controversy is about regulatory classification. Second, RBI regulates not only banks but also eligible non-banking financial companies. Third, the RBI derives its powers from the Reserve Bank of India Act 1934. We discussed Section 45IA dealing with the registration framework for eligible NBFCs. We discussed Section 45GA, which empowers RBI to issue prudential directions. We discussed Section 45L, which empowers RBI to issue directions in public interest. Finally, we understood that Tata Sons entered the regulatory discussion because of its legal classification and not because of the Companies Act alone. Next episode preview. In the next episode, the real legal analysis begins. We will answer some fascinating questions. What exactly is a core investment company? Why did RBI create this category? What are the legal conditions for becoming a core investment company? Can every holding company become a CIC? What is the difference between an ordinary NBFC and a core investment company? Why did RBI introduce the Scale-Based Regulation framework? What is the difference between base layer, middle layer, upper layer, and top layer NBFCs? And finally, why was Tata Sons placed in the upper layer? Once you understand these concepts, you will understand almost 80% of the Tata Sons controversy. So if you do not want to miss the next part, subscribe to Corporate and Securities Law Compass. Thank you for watching. I will see you in the next episode. Disclaimer. Viewing this video or accessing the content on this channel are free and does not create any professional, advisory, or client relationship between the speaker and the viewer. The content is shared solely for general educational and informational purposes. The speaker is a member of the Institute of Company Secretaries of India, ICSI. However, the information provided in this video should not be construed as professional advice, consultancy, or opinion under any law or regulation. Viewers should not rely solely on the information provided in this video for making legal, financial, regulatory, or compliance decisions. Any person intending to rely upon or act on the information contained herein should independently verify the relevant provisions of law and, where appropriate, seek professional advice from a qualified professional. The speaker, the Institute of Company Secretaries of India, ICSI, and any organization or listed company with which the speaker may be associated shall not be liable for any direct or indirect loss, damage, or consequences arising from reliance on the information provided in this video or channel. The content shared on this channel is based solely on publicly available information, general legal provisions, and academic discussion of corporate and regulatory frameworks. The speaker confirms that no unpublished price-sensitive information, UPSI, confidential information, or proprietary information of any listed company or organization has been disclosed or discussed in any video or content on this channel. The views expressed in the videos are personal academic interpretations for educational purposes only and are not connected with or derived from any confidential information obtained through employment, professional engagement, or association with any listed company or organization. Nothing contained in this channel should be interpreted as market advice, investment advice, or insider information under the applicable provisions of securities laws, including the SEBI Prohibition of Insider Trading Regulations 2015. Viewers are advised that the information shared is purely for general educational awareness and should not be relied upon for investment decisions, trading decisions, or regulatory compliance without consulting appropriate professionals and official sources.